Welcome back to Investing Talk podcast. Today, we are looking into a really interesting situation around Aehr test systems. They're a key player in semiconductor test equipment, and their Q1 earnings are coming up. It's a bit challenging, actually, because the data is thin, but the strategic angle is, well, fascinating. We're going to try and cut through the noise, pull out the most important nuggets for you so you can quickly get up to speed on their recent performance, and maybe more importantly, this big strategic shift they're making towards AI. That really seems to be defining their future. Okay, before we unpack all of that, if you find this discussion valuable, please take a second to subscribe, like the show, maybe leave a comment below. And hey, if there's a specific company you want us to look into, definitely let us know in the comments. We do look at those for future show ideas. All right. Let's set the scene. We're focusing on Aehr Test Systems Q1 fiscal year 2026. That's the 3 months ending August 31st, 2025. The official earnings release is expected around October 6th. Now, what makes this one particularly interesting and tricky is the lack of hard data. We have very limited information going into this report. That makes the immediate outcome highly uncertain. But, sometimes that uncertainty forces you to focus on the bigger picture, the long-term strategy, which is absolutely critical here.
Yeah, that lack of quantitative consensus is really the defining feature right now. You look at most companies, even around this size, and you'll find estimates, from Refinitiv, FactSet, consensus numbers for revenue, for EPS, for Aehr's upcoming Q1, nothing. Zero publicly available consensus estimates.
Wow, zero. That's unusual.
It really is. And it's not just a small detail. It creates what analysts call above average uncertainty. So the market can't play the usual game, right? Beat by a penny, miss by a penny, that's out. Instead, the reaction is likely going to hinge almost entirely on, well, two things.
Okay.
One, how did the numbers look compared to their own performance last year, Q1 of FY25? And two, what does management say? The quality, the specifics of their commentary about growth, about the strategic AI wins, that's going to be huge. Investors are basically flying a bit blind on the immediate numbers. And that lack of visibility, it raises a question.
Which is, why so little coverage?
Exactly. Why is it so hard to even find reliable historical surprise data? Or see how the stock typically reacts after earnings? It suggests maybe that institutional coverage is thinner than you'd expect. And that often points to a stock with maybe lower liquidity, or perhaps one that the broader analyst community hasn't fully gotten its arms around yet. It just reinforces why their own history becomes the main benchmark here.
That makes sense. If the analysts aren't setting a target, you look back. So let's do that. Their last confirmed report was Q4 FY25, ending May 30th, 2025. Actual revenue then was $14.1 million.
Right. And the non-GAAP EPS was actually negative. Minus 0.01 cents.
So when the new results drop around October 6th, the comparison points will be that $14.1 million from Q4 and whatever they did in Q1 of last year, which we'd expect was probably higher, right, given the trends?
Likely higher, yes.
Yeah.
Which sets a bar they need to clear.
Okay, so with the short-term numbers being such a question mark, let's shift focus. We really have to lean into the long-term story, which seems completely driven by the strategic pivot. The guidance from their last earnings call, Q4 FY25, was pretty clear. They're expanding aggressively, moving beyond that traditional silicon carbide focus, which was their bread and butter,
Right.
and targeting these new high-growth, frankly, high-power areas.
Precisely. They're explicitly aiming at AI processors, advanced photonics, GaN, that's gallium nitride, and also next-gen storage devices. And crucially, this isn't just talk. We saw real tangible steps during the Q1 period itself, or leading right into it. So July through September. This execution, that's what the whole growth story really hangs on right now.
Okay, so what were those steps? What catalysts did we see?
Well, let's tick them off. In September, they announced new evaluation orders. That's key evaluation orders for their wafer-level burn-in systems, their WLBI systems. And the order came from a, quote, leading AI processor supplier. A big name, well recognized.
Okay, evaluation means they're testing it out, basically.
Exactly. It's not full production volume yet. But getting that evaluation unit into a top-tier player, someone who could drive massive future volume in high-performance computing, that's a huge validation step. It signals real engagement.
And they're aiming right at the top, too, right? The hyperscalers?
Yes. In August, they announced that a major hyperscaler, I think one of those huge cloud providers, data center operators, often designing their own chips.
Right.
That one of them increased its production capacity by ordering new package-level test and burn-in systems from Aehr. Now, that's more than just an order. Getting inside the walls of those hyperscalers, especially for tools related to their proprietary chip development, That's notoriously difficult.
So that's a big win.
It's a signal of deep penetration. It means Aehr's tech is enabling the in-house AI chip development that's happening at these giants. That's a massive potential market.
And wasn't there a product launch too?
There was. Back in July, they launched their first production WLBI system specifically for AI processors, and they cited successful initial adoption, validation by leading chip companies. So launching a tailored product and getting that quick validation, it doesn't just open up a market, it shows they have the tech ready for this big shift.
It really sounds like they saw this coming. They had to prepare for this shift well in advance, which I guess brings us back to M&A. That Inkle technology acquisition they did, that seems pretty important now, especially for AI.
Oh, it's absolutely foundational. It's not just that they bought a company, they bought a critical capability.
How so?
Think about these high-power AI chips, training models, running inference. They generate enormous heat. They're incredibly complex. Reliability is paramount. The Inkle deal gives Aehr the ability to offer the whole package, testing at the wafer level and burn-in for the package part, both pieces.
And you need both for these AI chips.
Increasingly, yes. These next-gen devices often need burn-in testing at multiple manufacturing stages to guarantee they can handle the intense heat and power loads in real-world operation. If you're trying to sell test solutions for a, say, 700-watt AI processor, and you can't offer that complete end-to-end reliability testing, you're probably not going to win the contract. Aehr now has that integrated offering that's a competitive differentiator, and it significantly expands their addressable market in high-performance computing tests.
Okay, that context is really helpful for understanding the growth potential. But let's pivot back to the financials for a moment, because the reality is the past year showed some definite pressure points. Q1 needs to show improvement.
They absolutely do need to show improvement. Look at the full fiscal year 2025. Revenue came in at $59.0 million. That was actually down 11% compared to FY24, which was $66.2 million. So a noticeable contraction.
And margins.
Margins felt it too. Non-GAAP net margin for FY25 declined to 7.8%. So pressure on the top line, pressure on profitability.
And you mentioned seasonality earlier. That could be a factor for Q1 too.
It could be. Historically, Q4 tends to be seasonally strong for them. Q4 of FY24, for instance, had revenue of $16.6 million. But the most recent Q4 for FY25 only hit $14.1 million, even though it's typically a stronger period. So that suggests Q1, which often faces seasonal headwinds anyway, really needs those new AI orders to start kicking in significantly just to stop the year-over-year decline. That's the financial hill they need to climb this quarter.
Okay, but they do have some cushion, right? What about the balance sheet?
They do. They ended the fiscal year, back on May 30th, with $26.5 million in cash. That gives them flexibility, which is good.
And crucially, what about visibility? Backlog. That's what the market really wants to see right now.
Exactly. As of May 30th, the reported backlog was $15.2 million. And they also noted an effective backlog shortly after the fiscal year end that was slightly higher, $16.3 million.
So $16.3 million in existing orders heading into Q1. That's a pretty substantial base compared to the Q4 revenue number.
It provides some visibility, yes. Now, one other piece people often look at is insider activity. It can be a bit confusing sometimes. We saw some filings around October 1st. The CFO, CEO Chris, acquired about 1,000 shares, just over that, at around $6.67.
Okay, a buy. That's usually seen as positive.
Right. But on the other hand, Form 4 filings also showed the disposal of, get this, 76,229 shares.
Whoa, okay, buying 1,000, selling 76,000, that sounds mixed. Or maybe even negative. How do you read that?
Yeah, on the surface, that massive disposal looks like a huge red flag. But you really have to look at the context, often right there in the Form 4 footnotes. Very often, these large disposals by executives are actually non-discretionary, meaning it's an automatic sale, usually triggered to cover the tax withholding obligations when stock awards, like RSUs, vest. The executive doesn't actually choose to sell that big block. The company's broker sells it automatically on their behalf to pay the IRS, essentially.
Ah, okay. So it's not necessarily the CFO saying, I lack confidence.
Exactly. It's usually much more about scheduled compensation, logistics, and tax requirements. The small subsequent purchase, however, that is discretionary. That's the CFO putting their own money on the line, which is generally seen as a signal of confidence. So you need that context.
That clarification is really important. Okay, let's get to the core of it then. Since the analysts aren't giving us targets, we kind of have to build our own framework here. Thinking about potential scenarios for this Q1 report based on how much traction that AI pivot is actually getting right now.
That's the only way to approach it, really. Map out the possibilities based on history versus the potential of the new strategy.
Okay.
Okay, let's start with a bear case. Let's say maybe a 20% probability for this one. This assumes those recent AI wins, the evaluation orders, they just haven't converted fast enough to offset the drag we saw last year. So you'd see continued year-over-year revenue decline. Maybe Q1 revenue lands somewhere between, say, $11 million and $13 million.
And the market reaction?
If that happens, probably negative. You might see the stock react down maybe in the range of 10% to 15%. The evidence would be that contraction just persisting.
Okay. Then the base case. You've assigned this the highest probability, 60%.
Yeah, that feels like the most likely scenario right now. This assumes things stabilize. Maybe the decline stops. Perhaps those early AI ramps should fill the gap. Revenue comes in somewhere between $13 million and $15 million. The market reaction here would likely be pretty neutral, maybe plus or minus 6%. Investors would probably breathe a sigh of relief that the floor seems to be in, and then they'd wait for more data on the AI ramp in future quarters.
Hold on, though. 60% for stabilization. Given that 11% drop last year and the Q1 headwinds you mentioned, why so confident the floor is already set? Why not expect the decline to continue as the base case?
That's a fair challenge. The confidence, or maybe the rationale for that higher probability, comes from that backlog number you highlighted.
Yeah.
That $16.3 million effective backlog heading into the quarter is actually higher than the $14.1 million they did in Q4 revenue.
All right.
So if they convert even a decent chunk of that existing backlog, hitting that $13 to $15 million range looks much more achievable. The base case isn't necessarily assuming a huge surge in new AI sales within Q1, but rather that the existing order book provides enough cushion to level things off while that new business ramps up.
Oh, okay, that makes more sense. And the bull case.
The bull case. Also giving this a 20% probability, this requires those AI evaluation orders to convert significantly and immediately into real production revenue right now in Q1. This would push revenue higher, maybe $16 million to $17 million. If they hit that range, and management can clearly point to the new AI wins and hyperscaler orders driving it, the market could react very positively. You might see a price reaction north of 12%, maybe up to 18%.
Okay, let's unpack this then. So for you, the listener, trying to make sense of this, with all this uncertainty, these different scenarios, what's the one single thing you should really focus on during that October 6th earnings call?
Yeah, the most critical metric, given everything we've discussed, probably isn't the Q1 revenue number itself. We know that's going to be noisy and lack analyst context. The most important thing to watch is the reported backlog and bookings number heading into Q2.
Forward-looking.
Exactly. That signals the visibility on future demand. That's what drives a growth stock.
Yeah.
You need to listen for specific commentary confirming that those recent evaluation orders, the AI processor stuff, the hyperscaler wins, that they are successfully converting into real binding, high-volume production contracts. That backlog growth is the engine that validates the entire AI story Aehr is telling. That's number one.
Got it. Backlog and bookings, that really clarifies things. So final thought here. Given this high uncertainty, the lack of analyst data, if maybe someone misses the immediate reaction after the earnings call, how else can you track investor sentiment? How can you gauge if the market is actually buying into this long-term AI narrative for Aehr?
That's a great question, and it leads to maybe a final, more provocative thought for you to track, something beyond the earnings call itself, and that is institutional flows.
Meaning, watch what the big funds are doing.
Precisely. Since the analysts aren't giving clear signals, you need to see how the so-called smart money is positioning itself. There are two key dates coming up later this year to watch for this. First, November 15th, 2025. That's when the Q3 13F institutional holdings reports come out. Those filings will show you which large funds were buying or selling Aehr stock during the third quarter, which includes the period right around this earnings release.
Okay, 13Fs on November 15th. What's the second date?
Keep an eye out around December 2025 for ETF rebalancing announcements. Both the 13Fs and any potential ETF inclusions will reveal how institutions and index funds view Aehr's evolving role in the semiconductor AI test supply chain. Any notable pickup in ownership by large institutions, or especially getting added to a relevant tech or semiconductor ETFs that could act as a major sentiment boost and a liquidity accelerator late in 2025. And that could provide confidence in the story, really regardless of whether these Q1 numbers initially land in the base case or even the bull case scenario. It's about that longer-term institutional validation.